Here's something that's never happened in Canadian recorded history, not once since Confederation. Canada's population actually shrank last year. And I want to tell you why that matters to you, because it's showing up right here in Guelph's housing numbers as of this month, 2026. If someone at a party asks me, and I often get this question, so how's the Guelph real estate market right now? I tell them it really depends on what you're looking at, because right now we don't have one market, we actually have two. And I've mentioned this before, and they are moving in very different directions. In this video, I'll walk you through the three big forces driving what's happening: population, interest rates, and jobs. And then we'll get into the actual April numbers broken down by property type. And by the end, you'll have a clear picture of where things stand and what it means if you're thinking about making a move now or in the near future. So before we get into the local numbers, I really like to zoom out. There are three things I track as the underlying signals of where a real estate market is headed. And I've mentioned them already: population growth, interest rates, and job growth. Think of them as the bellwethers, the early indicators. And right now, all three are giving us mixed message. Let's begin with population. Canada just recorded its first annual population decline since Confederation. Statistics Canada put population at just over 41.4 million at the start of 2026. Now that's down about 102,000 people from a year earlier. Now that's not a rounding error, that's a real reversal. So what happened? Well, the federal government dramatically pulled back on temporary residents, including international students and temporary foreign workers. That wave that was driving demand for rentals and entry-level homes, it's receding, and Ontario took the biggest hit. BC and Ontario together saw their population decline 0.7% in the past year. And as I've mentioned, that's just over 100,000 people. Now here's the honest nuance on this. Guelph isn't Toronto. Of course, we know that. We weren't a major destination for international students in the same volume as the GTA. So this hits us less directly than it hits, say, Brampton or Mississauga. But we're not immune to the provincial ripple effects. And when we look at interest rates, well, the Bank of Canada held its overnight rate at 2.25% at the end of April. That's the fourth consecutive hold. And prime rate is sitting at 4.45%. And remember, prime rate is the rate that banks offer to their most credit-worthy customers. So prime plus or minus, you'll hear at the bank. And here's the shift. The rate cut conversation is over. It's unlikely we're getting more cuts. In fact, some economists are now flagging the possibility of rate increases in the second half of this year. Scotiabank has penciled in 3 potential hikes. Now, I really think this is highly unlikely, and here's why. Over 1 million Canadian households are renewing mortgages this year. Many of them locked in when the Bank of Canada rate was under 1%. So their payments are definitely going up, and that matters for consumer confidence. Increasing rates, even a quarter point, 2 or 3 times, will impact mortgage renewals substantially and make consumers even more cautious, which translates into less spending and less growth. Less growth means if interest rates went up, it would slow spending even more than it is now. And looking at jobs, well, Canada added 14,100 jobs in March. That sounds okay until you realize we lost over 109,000 in the first 2 months of 2026. So we're recovering, but slowly. The unemployment rate right now sits at 6.7%. Now, the labor market isn't in free fall. People still have jobs, but hiring has slowed. One thing worth noting, the finance, insurance, and rental sectors lost 11,000 jobs in March alone. And those sectors are typically a leading indicator for housing activity. Definitely worth watching from here on in. And again, if job market is slowing, a rate increase would have more negative effect on consumer confidence. So when I put those 3 things together, population decline, and population is declining, rates parked, jobs cautious, it paints a picture of a market where confidence is still missing the missing ingredient. People have the financial capacity to move in many ways. They just aren't convinced this is the right moment. And that's really key. And I want to spend a moment on rent because it's relevant for a few reasons. Some of you are thinking about renting as part of your plan. Maybe you sell the house and rent for a year while you figure out what's next. Or maybe you have an investment property and you're wondering about that side of things. Well, here in Guelph right now, the median rent for all unit types is around 2,100 per month. That's actually down about 2% from last year. Now, a one bedroom runs between 1,900 to about 2,200. A two bedroom is roughly 1,950 to about 2,700, depending on the building and the amenities offered. Rent is cooling across Canada. RBC Economics is forecasting average rent increase of about 3.6% nationally for this year, roughly half the rate for the prior 2 years. And the reasons are straightforward: fewer new arrivals, more purpose-built rentals being completed, and better ownership affordability, pulling some renters into buying. How does that look for Guelph specifically? We're more insulated than cities like Toronto and Vancouver. Those are the markets seeing the sharpest rental softening. Here, rents are stabilizing, definitely not collapsing. But if you're a landlord with a condo unit and you had a tenant leave recently, you're probably noticing it's taking longer to fill, and you're accepting, or maybe accepting, a bit less than you would have 2 years ago. All right, so let's get into the Guelph specific numbers. 138 transactions in Guelph during April. That's up 16% from March, which on the surface looks really encouraging, but compared it to April of last year, we're actually down almost 10%. Year to date, Guelph has seen over 400 sales versus over 500 sales the same period. That's a 13% difference. The average sale price across all property types is about $748,000, down just over 2% from March and down 5% from a year ago. The year to date is $742,000 versus $780,000 from year over year. So let's zoom out to get the full picture. Here's the stat that tells you most clearly what kind of market this is. 80% of properties sold below their asking price. 1 year ago, that number was 64%, and only 15% sold above asking versus a third a year ago. So buyers are negotiating and they're winning. Now, the reported average days on market is 34 days, up from 29 a year ago. These aren't realistic reflection of how long properties are taking to sell. The reason is many listings get taken down and relisted, which starts the days on market counter. So I strongly suspect the real days on market is around 40 to 55 days. Houses are sitting longer and sellers are working harder for every offer. I want to go over termination numbers because they really deserve a mention, and they support the reasoning I just mentioned. 134 listings were terminated in April. That's up 70% from a year ago. When listings terminate at that rate, it usually means one of two things. The seller tried the market and didn't like the offers and pulled the listing, or the seller and their agent couldn't agree on a price, a strategic price. And either way, there are a lot of frustrations baked into that number. And this is where it gets really interesting, because when you break the April numbers out by property type, we continue to see two very different stories. I've talked about this in previous market updates. The trend continues. Detached homes priced appropriately and show well will sell quickly. There's demand for detached homes. Remember, building permits for detached homes remain at 1980s levels. There's not the profit for builders to build these types of homes. So for boomers who have their detached home, there's continued demand definitely for that type of home. And remember, buyers want move-in ready. They don't have the money to do updates. With the price of detached homes being in the 800,000s means you need, and if you're looking at 20% down, that's $160,000 for a down payment. With that kind of cash needed, there's typically not a lot of cash left over to do updates or renos. Remember, buyers are buying a mortgage payment. They're living on a monthly cash flow. So if they can afford an extra $150 to $300 a month, in payment, and that gets them a house that's updated and more modern finishes, then that house becomes by far and away more attractive. And detached homes, well, 74 sales in April, virtually identical to April last year. So detached transaction volume is holding. The average price came in at about 885,000. That's down 4%. And the median is down about 1% year over year. So relative to what condos are doing, detached is holding its ground. And when we look at the sale price to list price ratio, that's 98%, meaning buyers are getting about 2% under asking on average. Now, 3/4 of detached homes sold below asking compared to around half a year ago. So that tells you a story. And only about 18% sold above asking versus 40% a year ago. Now, the multiple offer frenzy on detached homes is clearly in the past. You do see it sporadically, though. Terminations on detached are up 82% year over year. 51 listings were pulled last month. Sellers who priced for 2023 markets are discovering 2026 has different rules. Let's go to condos, apartment and townhouse. Here's where the picture changes significantly. 42 sales in April. That's almost 18% from a year ago. The median price is 482,000, down about 14% year over year. A third more listings are showing up from a year ago. So there's more supply, fewer buyers, lower prices. That's the math. The termination story in condos is really stark. Terminated listings are 109% from April of 2025, more than double. Condo sellers are listing, not getting the price they want, and pulling the listing off. Some of them are investors who bought a few years ago and are running the numbers on their rental income versus carrying costs and deciding the exit is better now than waiting and doing it later. And let's look at year to date. The average condo price in Guelph is about 529,000. It's down over 10% from prior year's 590,000. So that's a meaningful correction. And if you bought a condo in 2022 or early 2023 at peak prices, you are sitting on a paper loss right now, unfortunately. And when we look at attached row houses, smaller sample, only 11 sales this month. So take this with a bit of caution. The average price is virtually flat year over year. That's actually the most stable reading in the whole data set. 100% sold below asking, but days on market dropped from 66 days last month to 17 this month. So when a townhouse is priced right, it's definitely moving. And let's look at year to date. The price is softer by about 5% less, but still better than what condos are doing. So back to the party question. How's the market? Well, here's what I'd say. If you're thinking about selling your detached home, the market has softened, but it hasn't fallen apart. You'll need to price it accurately and not last year's price and definitely not 2022's price. Priced right, there are buyers, but they're taking their time and 80% of them are expecting to pay less than asking. Work with someone who knows the current comps, not someone who tells you what you really want to hear. And if you own a condo and you've been watching the market, the numbers are what they are, unfortunately. Prices are down 15% from last year. More condos are coming on the market, and that trend doesn't reverse quickly, especially when the population growth is slowing. And if you need to sell, price for today's market. If you don't need to sell and you have more time to wait, well, then wait and see how the next 6 months shakes out. And if you're a buyer, whether you're downsizing into a condo or buying your first property, this is genuinely the best market to buy in that we've seen in many years. There are choices. You have time to think. You can negotiate. You know, a year ago, a third of properties were going above asking. Today, it's 15%. That shift in power is real and it's yours to use. And if you're wondering whether to rent for a transition period while you sort out your next move, rent is cooling, inventory is improving, and a 1-year lease in Guelph is around 2,100 to 2,300 range. And it gives you time to be patient about what you want to buy next. And that's not actually a bad option right now for people. So the three bellwethers I watch, population, rates, jobs, are all telling a cautious story right now. The housing market in Guelph is reflecting that caution, but cautious doesn't mean stuck forever. Canada's immigration plan is designed as a 2-year reset, not a permanent change. Population growth is expected to return by 2027, 2028. And the fundamentals of Guelph as a place people want to live, the university, the manufacturing base, the proximity to the GTA, those don't change. What we're in right now is a period of recalibration. Prices are adjusting, expectations are adjusting. And for the people who are waiting on the sidelines for some breathing room, well, that breathing room is definitely here.